Hello, everyone. Welcome, welcome. Welcome to your Business in Digital, the summer wrap-up edition. Today, I am going to be talking about the cash flow. The struggle is real. I am Andrea Ragu, your favorite virtual CFO, and I will be joined by Michael Wilshire, Director of Sales and Operations of Monovan Digital, and we're going to talk about cash flow. So let's hit it to the intro. All right, welcome again. So today we're talking cash flow is real. Well, the struggle is real. But before we get to that, let's hit to some call to actions. Here's what you need to do to stay in touch with us. Connect with us. YouTube, LinkedIn, Apple, Instagram, basically wherever podcasts are found. We want you to connect with us, subscribe to our channel, our YouTube channel in particular, subscribe to LinkedIn so that you can catch up with us and you can stay in touch with all these episodes. So I bring to the stage Mr. Michael Wilshire, Director of Sales and Operations of Monovan Digital, and he's going to lead us through this little discussion today on cash flow. And the struggle is real. Michael, do you agree?
I agree 100%. I mean, cash flow, so many things to say about it. Even, I'm coming from a background with some financial experience, of course, and I can say that, it was even, in school, it was the one statement that was like, oh my God, putting together this cash flow statement was the hardest part. All the other statements, no worries, but putting together a cash flow and then doing it consistently. Yes, absolutely. I agree 100%. The
Yeah.
struggle is real. So I don't know that I'm leading the conversation, but I'm definitely here to have the conversation with you because, you are the virtual CFO. So lead us through. What are we talking today?
So, what we're going to talk about today is the struggle that we face as small business owners with our cash flow, in particular, this thing called the cash flow statement, also known as the cash flow projection. And you're right, Michael. When we were in school, I remember as a accountant learning accounting things, balancing that cash flow statement was like the cream of the crop, right? To be able to accurately balance that cash flow, right? But when you are a small business owner, cash is king. But I always like to preface that and say, but management is queen, right? So it's one thing to understand the cash flow, it's another thing to manage it. And this is where business owners are struggling. And if you're not sure if you're struggling, here are some tips, here are some indicators that you might be struggling. One, you don't have enough to meet your obligations, right? You're trying to decide who to get paid, or you're waiting for funds to come in before you make payments. Or worse yet, you have to use a bank overdraft because you find yourself in difficulty. So if any of these things are speaking to you and if any of these things are happening to you right now, it means the struggle is real for you. And that's what we want to tackle today. And the way that we're going to tackle it is that we have 4 common questions about cash flow statements for small businesses. We're going to tackle 4 common questions. We're going to go through each one and see how it fits into your business.
I am so here for it.
Are
Foremost
you
common
here for it?
questions. I am absolutely here for it. Listen, if you're listening in this morning, if you're listening in today, this, catching it on the replay later on, definitely this is one for every small business because, as you said, cash flow is king. I like what you said. But management is queen,
Management is
right?
queen.
So yes, you've got to have the 2 in place. So yeah, let's jump in and see what this is all about and answer some of these questions.
All right. So the first question of the first common question is, what is the difference between profit and cash flow? So here's the main difference. First of all, the fact that we're saying what is the difference means it's not the same, right? I want people to understand that immediately, right? So if you head on to the next slide, Michael, profit and cash flow are 2 completely different things. Profit is a concept, right? Profit is not cash. Cash is real money, meaning cash is an asset. Cash is something in your bank account. Cash is something in your wallet. You don't see profit in your wallet. You know what you see in your wallet? You see cash, because profit is an accounting concept made generated to indicate a certain level of financial health. Profit does not equal cash, because you can actually not have profit, as in make a loss, and still have money in the bank, right? The profit equation is profit, sales minus expenses equals profit. So if the figure is positive, it's profit. If the figure is negative, it's a loss, right? So you could see how immediately the two don't equate, because that does not equate to monies in your bank account. The reason why it doesn't equate is that because profit is a concept, the profit equation is going to include things that the bank account does not. And one common example is things like expenses like depreciation, right? Or things like interest. These things don't necessarily appear in the bank account, right? So depreciation is a big example. Depreciation is an accounting concept that accounts for how you use your assets. So if I say profit less expenses, income less expenses gives me profit. Depreciation is not included in my bank account. So that's why I could still make a loss and have some money in the bank account, because profit is taking into consideration costs that don't have a cash impact. It's not reflected anywhere in the bank account. So I want people to understand that that's a critical thing to understand, because most business owners are using their bank account as a gauge to understand how the business is going. And while it is a good gauge to see how things are going, it's not the only gauge, and it's not a gauge to substitute for looking at profitability. It's two completely different things. And the other reason why the two never seem to be equal is because profit does not take into consideration when the money is actually paid to you, or when you actually pay something. So if today in the month of August, I have expenses, I've gotten invoices from suppliers that total $5,000, and I have issued invoices to my own customers of $15,000, my profit is going to say 15 less 5 equals a $10,000 profit. But here's the problem. I didn't get all that 15,000 from all that money in sales from my customers just yet. So my balance in my bank account does not reflect the profit equation, because I haven't gotten all the money. The timing of me getting the money is not the same as when I have to account for it in my profits.
Oh my word! There's so much I want to unpack there, but I
I've said
know
a mouthful.
this
I've
is.
said a mouthful, but I
I,
really want people to understand the difference.
but so I want to try to break it down and see if if I got you right, because I feel like I'm in the class. I'm like sitting at the front of the class and I'm listening intently. So that concept, as you said, I'm now wrapping my head around the fact that if I'm calculating profit, then I am also including non-cash line items,
Right.
right? I mean, just so that's one side. But my cash flow, as you said, you don't, and you also look at profit at a point in time, right? Or at the
Yes.
end of a period,
A period.
Right? So you're looking at a point in time, at the end of a period, that cash flow is an ongoing situation, right?
So cash flow is ongoing, but it's just to tweak what you're saying. Profit, we look at profit for the whole period, right? So the month of August, we had 15 less 5, right? Your cash balance is at the end. So at the end of it, you're saying, well, how much money do I have in the bank account as at this period? But apart from it being as at the end, if you look at your bank account, you're not going to see 15 come in and 5 go out.
Right. Got it. So yeah, that's you're already solving my struggle. I'm feeling a little easier, feeling a little better, starting to get it. So
You're starting to get it.
yeah, absolutely. So that cash, that cash position is what's the real thing we're looking at.
The real thing, remember I said, profit is not in your wallet, profit is not in your bank account. What is in your bank account is cash.
Correct.
right?
So now I understand, because yes, I might go to the bank and say, okay, listen, this is how much I'm supposed to collect. But because of the timing, and that's what you're
Correct.
talking about with the
Because of it.
overdraft, because of the timing of it, I'd like you to cover me for this much of it,
There you
right?
go.
Because of course the bank will give you a discount with whatever, right? But that's where we go. So yeah, I think this is where we start. I think it's a great start to the conversation. That, highlighting that difference between cash and profits. So yeah, let's keep me
All
going,
right.
right? Let's see what else we have today.
So now that you understand the difference between cash and profit, let's look at the second question that is most commonly asked. So how often then should I prepare a cash flow statement, and how often should I be looking at my cash flow balances, right? Well, here's the answer. Best practice is monthly, right? So if we go to the next slide, best practice is monthly. Absolute. So it means every month you balance your affairs by going through your position and you look at your numbers, and you could balance your cash flow statement to see what is happening at the end of the month that just happened in the previous month. But I know that could be a bit tedious. I could already hear business owners saying, well, I don't have time. Who have time to sit down and go through that? Well, this is why you have accountants, guys. This is why you have people like me in your business, right? So we can't really get it. Before you get to best practice, quarterly is a good place to start. Quarterly is a good place to start, where every quarter you could sit down and look at the affairs of the last quarter and balance your cash flow to see what occurred. But if you can't even do that, well, the bare minimum that I think you should do is at least twice a year. So 6 months, biannually at a minimum, try to look at what happened in your business and try to understand your cash position at least twice a year, so that you have an idea of what's going on. So that's how often you should be preparing these numbers.
All right. So, well, we always try to go for best practice, right? But I love that you're giving us a little middle ground that we could start with. But really want to ask and just talk about is, I want to understand how do I use, so I do my cash flow statement. Let's say, for example, I do my cash flow statement today, and I've done it for, let's just say I've done it for the next month. Um, when you say tracking it, and so am I looking into my accounting platform? Do I just monitor what was projected versus what I'm really seeing? Is that where I leverage that digital, that it's not me going to a spreadsheet? We're not telling anybody to prepare a spreadsheet. It's, once it's set up, then I can actually, over the course of the month that I've planned for, be following to see, or is it more important to see at the end of the month whether I was in line or not? So I guess my question is, do I follow it along the way, or do I monitor it at the end of the period?
So it's a monitoring situation, but you're monitoring based on what you projected and to start with. You want to understand, how are you performing the way that you thought, right? So this is underscores the whole thing of benchmarking yourself, right? What is it that you wanted to achieve, or what is it that you're trying to achieve, which we love to talk about on our show. But what you're looking for is, did I meet what I said I was going to meet? Or if I did, or if I didn't have a target, what happened in the period that caused this result? So I'm reviewing my records, and I realize, oh wait, I don't have enough cash, or my cash balance is at $1,000. And I thought, based on what I knew my business to be, I had a really good month, right? And this is the thing, business owners, you all have the numbers, but it's in your head. We all have a running total of what's going on in our business. We do know it, but we just have it in our head, and we don't really bring it out in in a formal way. But you always have a running total of what you think is going on. And then the bank account is usually that hit of reality that says, well, no, what you thought was happening is not what was happening, because clearly the reality stepped in and you don't have enough, right? Or let me be a little bit positive, you probably had more than you thought. But when you go back and you review, you might realize, well, I have more because I haven't paid something yet. Because there's a payment that didn't come out yet, or there's something that was supposed to happen that didn't happen. So that's what I'm saying. It's important to compare yourself to what you have in your mind as your benchmark or as your position, as well as, comparing to see, well, did I exceed my expectations, or is there something that I did not consider? And especially you want to do these things, especially if your business is seasonal, if you have peaks and lows, you want to do this how often, because we're talking about how often, right? You want to do this as often as possible if your business is seasonal, because remember, when the low time comes, there isn't going to be much money coming in, and you want to make sure that you have prepared yourself well for that low period. So when it is high, definitely be in there making sure that things are happening the way they're supposed to be happening.
So as you say that, it makes me think that, of course, this definitely applies, the types of businesses this applies to, it applies to every business. But I'm hearing you, kind of sound in the horn that, listen, if you are in that kind of seasonality, and I think maybe, the first thing that comes to mind easily, of course, is agriculture, right? Where, you have, just one time of the year maybe where you are selling, right? But then that money has to go for, replanting everything for a whole year before you get, actual cash income again. So, even that's an easy way to look at it, I think, as far as, why that cash flow is important. And as you say, I think you touched a nerve. I feel it'll touch the same nerve in the audience that, yes, we have this running total in our head. We absolutely do. I absolutely agree with that. I nearly laughed out when you said it. And I agree 100%. I know that this is the total in my head. And then, take a look at the account, and I'm glad that you tried to make it positive for us. But the reality is, we're here talking about it because the reality is actually what you said first, where I look at the account and I'm like, what's happening, right? Where, why don't I have money, right? So, and I think that takes us really nicely into the next point of your discussion. What to do when I have a negative, I forecast a negative balance, right? And I didn't plan to, right? But it's a calculation. I'm doing a calculation. That's just the reality. It may end up being negative.
Right. So yes. So your cash flow calculation, just to make sure everybody's clear, when we say negative, you get a negative if your inflows are lower than your outflows. So if you take inflows minus outflows and you get a negative figure, then it means you're having a negative balance, which means you don't have sufficient cash coming in to be able to support the obligations of the business. Right? And this is a common thing that happens in business. Everybody knows it's not sunshine and rainbows every month. You are going to find situations where the cash is not going to be sufficient, and you're going to have to take steps to remedy it. So what should you do? So the first thing that you want to do is, well, you need to understand why is it in a negative. Is there one particular item that is causing a negative in this particular month, right? Is there something that is occurring that is preventing the cash flows from being as high as you would like? So what is the cause? Is it because a customer has not paid, especially to speak to my fellow consultants and those in service-based businesses, when we issue invoices to clients and we give them 30 days to pay, and it is now day 40 and they have not paid? That could cause a negative balance because you were expecting money to come in and it did not come in. Right? So you want to understand, well, what is causing the negative? And then once you understand the cause of the negative, you could now take the steps to remedy it. So if we're looking at customers not paying, well, right, it means you need to probably have a collection drive to make sure, well, what is going on with these customers that are not paying? Do we need to drive them specifically to pay us? What are the steps that we can take? But basically, you need to get them to pay. If it is negative because you have one particular transaction, an outgoing transaction, and maybe it's major. Maybe you in that particular month, you're projecting to purchase a new laptop, right? You say, well, I want to purchase this new laptop in this particular month. But when you do this projection, you realize, but if I do it in that month, I'm not going to have enough money. So you could then say, well, let's defer that purchase, or maybe take the purchase on your credit card so that the money doesn't come out right away. Buy you some time, right? Understand the cause. And just in general, increase as we said, the equation is inflows less outflows, right? So if you increase one and reduce the other, that's going to balance you out. So you want to increase the cash coming in and then reduce the cash going out. So if it is probably not cause of a specific thing, you might want to just look at your items generally and find a way to increase cash coming in. So maybe you might want to say, here, what, let me run a particular sale this month so I could generate some more a promotional sale. I get some more sales coming in. Maybe there's a particular item that you want to increase the price on, or you want to offer some special offers to just drive people to buy more. That will give you some more cash. And on the flip side, reducing cash going out, you might want to look at your expenses. If there's anything that you can't defer, or if there's anything that you can reduce, right? So my favorite example, if you've been on this show before, you would hear me say the word subscription addiction, right? Review those subscriptions, and if you're looking at those subscriptions and you find too much money is coming out every month, you might want to take a look at those subscriptions and reduce it to reduce the cash going out. So just generally increase cash coming in and reduce cash going out.
Listen, before we go to the last point, because I just want to, rewind a little bit. And so I'm glad that you touched on subscriptions, because the experience has been that as small businesses, a lot of the services that we use are subscription-based services. And what you might find happening is that you've paid for a year in advance, right? And typically you're paying for maybe 7 to 10 platforms, right? 7 to 10 different things. And you did not sign up for all of them on January 1st, 2024. So sometimes those charges can catch you off guard, because you didn't make a note of, it's a year subscription. You don't think about it for a year, right? And then it rolls around, and then you find like certain subscriptions overlapping, and that can easily put you into that cash flow situation that you're talking about, that you realize that, listen, from a planning perspective, sales wise, you plan okay for the year and all of that, the quarter and all of that, but in the way in which money needs to come in is not catering for when those subscription payments are due. So I love that you touched on that in the last one. I think that's the absolute example of where cash flow can tie you up as a small business in this digital world today, with that subscription addiction, as you put it.
Absolutely, absolutely. And that, you see how you say, you're tying yourself for a year and you forget about it, right? Now, if it's coming out every month, you're feeling it, right? You're going to remember. But when you sign up for a year and that year comes around, you all of a sudden you say, but wait, I forgot about this, right? And then you don't even realize that you're paying, and that you're paying for this service until it's too late. So you really want to. That's why I call it subscription addiction, because I just feel like we love to click subscribe. But just as a note, if you're in that position, I would suggest that people do a subscription audit and just audit your services and see which ones you really want to pay for. And before you even pay, assess it. Take a month to month. Don't let the ad get you to click a year right away. Test it out for a couple of months, take a month to month, see how it's working out first before you're ready to commit. As Michelle likes to say, date a little bit. Michelle likes to talk about on the show, likes to talk about dating before you buy. Date them a little bit, try it out for a couple of months. Make use of that trial period, of course, which is usually free, before you commit to this year-long subscription, because it's, as Michael said, it's going to pop up on that cash flow statement when you least expect it and cause your cash flows to be out of balance.
Correct. So that brings us to the last most common question that people have. How far do we plan, right? So, you talked about, setting it up ideally monthly. then you gave us a little out, a little in between, which was it quarterly?
Quarterly.
It was quarterly, right? And you said, listen, if you're really scraping the bottom of the barrel, do it twice a year. But when I do it, am I doing it for 1 month, 2 months, 3 months, etc.? So let's get into this last portion of it before we get out of here today.
So, right, how far into the future? So the first question, we only spoke about time, we spoke about how often, and that spoke about how often are you looking at it. But this question I was speaking, well, when you do look at it, for how long into the future are you looking at it? So if your business is stable, and when I say stable, I mean you've been in existence for a number of years, you're a well-oiled machine, things are happening in your favor, things are running smoothly, and your cash flows are more or less stable. You don't have peaks and lows. You more or less have things covered. You could just project 3 to 6 months into the future, just up to the next 6 months, see where things are going. And that's if your business is stable. If your business is not yet stable, so you're going through something and you're not sure where things are going to go, you don't have in your mind a clear picture, you want to be able to do it at least 1 to 2 years into the future. So this would fall nicely for people that are now starting out a new business. You really don't know your market yet. You're not sure how things are going to work in your favor. You're not sure how the market is going to even respond to your offering. So you can't project sales accurately. You want to be able to look at least 1 to 2 years into the future. However, if your business has persistent cash flow problems, and this is so I'm not even talking about if you're stable and you've been in existence for even if you're in existence for a long time, but you're persistently having cash flow problems and the struggle is real with you, right? You want to forecast all the way into the future until those negatives become positives, and that they become positives for a consistent period of time. So this could take up to 3 years to fix your cash flow problems, depending on what it is, right? So you want to be able to see, so if for the past year, you've been in and out of your bank overdraft, or you've been dipping into savings, trying to fix, trying to get, meet obligations because the business not generating enough cash, you want to be able to do a cash flow statement of up to 3 years that shows positive flows, maybe for at least out of those 3 years, maybe up to at least a year, right? Because then that would say that the thing, the remedies that you put in is fixing the problem, and it is, your cash flow is responding to what you're doing. So you want to be able to project maybe up to 3 years. If it is you finding yourself currently having persistent problems, and you need to take corrective action, project up to 3 years to ensure that the corrective action is implanted properly into the business.
Wow, this is why we appreciate you and being a part of this show, because I see every reason for a small business to reach out for you for this information, for guidance, because it seems again, it brings you back. As much as you've explained things, looking at this last slide, I felt again, yeah, boy, the struggle is real. Oh my word. So all the reasons to reach out to your accountant, reach out to Andrea, for sure, virtual CFO. Andrea, I really enjoyed this discussion this morning. Well, keep saying this morning, it's afternoon already. Oh my God, what a day. So, any closing thoughts on, businesses and doing their cash flow, as we talk about, lessening the struggle?
Yeah, so definitely the struggle is real, right? And like I said, the symptoms, if any of the symptoms that I spoke about are speaking to you and you're finding yourself in that situation, maybe there's one problem that's persistently bugging you, or even if it's a combination of different problems, you need to take a second look at your finances. You could do it on your own. There are many tools available as well. On this show, we always talk digital things. I mean, Michael mentioned the spreadsheet. It's not always my favorite go-to position, but if that's where you need to start, go ahead and start to run some numbers. But you want to be able to look at your numbers and understand where your cash flow is going. Because when you are a small business, your ability to generate and sustain your own cash is the difference between existing and not existing, right? That's bottom line. If there's no cash, there's no business. So if you have never done a cash flow exercise, make sure you reach out to an accountant to help you, because it can be overwhelming the first time. Of course, if you go on Google and you Google cash flow, you'll find a whole set of litany of things on cash flow, right? And it may be overwhelming, but definitely these are the types of conversations that you need to be having with your finance professional, whoever that may be in your business, right? You need to be having these conversations. And in our earlier point, we addressed how often you need to be doing it. I told you best practice is monthly, quarterly is your little opt-out, but at a bare minimum, at least twice a year, try to have these conversations, right? So get your act together, guys, and look at your cash flow, because cash flow is king, but management is queen.
Listen, Andrea, I was really glad to join you this morning. I think this was a really worthwhile show, and I know it's a conversation that many small businesses have. So definitely connect with us. Subscribe on YouTube. Catch us everywhere on every podcast channel, on your favorite podcast channel, and definitely look out for season 5 as the fall approaches. So it was great being here with you, Andrea, this morning. Looking forward to YBID coming back full next season. So small businesses out there, listen, this is a reason to reach out. Andrea, I think you were being a little modest. Andrea has a great cash flow tool. So definitely check out her presence, check out her website, Andrea. Tell them where they can find you, check her out on LinkedIn, etc. But
So you
definitely
can
connect
find
with
me
her.
on LinkedIn primarily. You could find website under construction, but definitely reach out to me on LinkedIn, Andrea Ragu, or even on Instagram, your virtual CFO 868. If you're not on any of those platforms, hit me an email, contact@yourvirtualcfonow.com. Send me an email, drop me a line.
And I'm Michael Wiltshire, Director of Sales and Operations at Monovan Digital. I was really glad to be here this morning. We hope you have a great rest of your day, and thanks for watching Your Business in Digital, the Summer Wrap-Up.